The Quantum Group USA, LLC in California, DBA Quantum Distribution and Insurance Services. Advisors are responsible for following all insurance, DOL, FINRA, SEC, broker-dealer, and compliance officer approval requirements prior to distributing this information to clients. From our studios in Scottsdale, Arizona, welcome back to the Quantum Industry Insight Podcast. And today is Howard Shen, our guest, Vice President and Market Leader at Invesco, where he works closely with financial professionals to help navigate market trends, investment strategies, and portfolio opportunities in an ever-changing economic environment. And with that deep insight into investor behavior and market dynamics, Howard brings a practical perspective on what advisors should be watching and how they can help clients stay focused through uncertainty, which is the norm right now. Today we're talking about, Howard, midterm elections. I just saw your presentation to Quantum. Very interesting. You're really good at what you do. Midterm elections, historically, how do they impact market performance? I know the answer from your presentation, but what patterns, if any, should advisors be watching, or should they just ignore the whole thing?
Well, certainly not something to be ignored, because in our experience, our clients are talking to us about this, right? And if it's important enough to our clients, then certainly it's important to us. Now, we know the punchline, we know the short answer, which is elections generally don't have a lot of impact on either the direction of the economy or on financial markets. Okay, it really doesn't matter which side wins, because as much as politicians would like to think that they have a big impact on the direction of the economy or the direction of markets, the evidence suggests otherwise. And so, we certainly do want folks to go out and vote their values and vote their preferences. But when it comes to their retirement finances, when it comes to their investments, we certainly want to make the point that it really doesn't matter.
And what happens typically in the year following midterm elections? Obviously, we're in a situation right now where, if you read the news, it looks like a bloodbath, for the Republican Party. But who knows? But again, whatever happens in the midterms, apparently it doesn't really matter too much. What happens the following year?
Yeah, so generally in the 12 months after the midterm elections, we see markets advancing, right? We see them going up, and generally in the region around 15 to 16%. And we've seen this pattern kind of repeat itself over and over and over again, and we look at the different midterm elections throughout time, and it didn't matter if Republicans won, it didn't matter if Democrats won, it didn't matter if neither side won. The patterns were very similar, that we generally see positive results in the stock market in the year after the midterms.
What does data tell you about, for example, a fully Republican government, a Democratic government, or just a divided government? Is there any difference between those three?
Yeah, so we hear that one a lot, right? And generally what we hear is divided government is better for markets because of gridlock or any other reasons that people want. Right, exactly. The statistics still don't bear that out, right? We just haven't seen enough observations throughout our country's history to tell us one way or the other, because we can isolate what happens in the stock market when only Republicans are in charge or when only Democrats are in charge. And you get kind of middle of the road returns. But then when we look at what happens when one party is in charge of the House and the Congress and the presidency, and you kind of mix and match different results there, you get some either great results or you get some not so great results. And none of these, though, is statistically significant enough for us to make a determination that one party or another or neither party is good for markets.
Do politicians have any real power in this economy, in the market itself? I mean, I can look back to when Reagan was inaugurated, and he reduced taxes so much that it did have a positive effect on the economy temporarily, but then everything goes back to normal. But do they have any power?
Yeah. So I think they'd like to think they do.
Right.
But the evidence that we've seen suggests that what power they do have is minimal at best. Certainly, policies, as you mentioned, are important, but the real power in Washington that affects the economy and financial markets sits with the Fed. Right? The Fed has two jobs. Right? They either they have to maintain pricing stability, and they want to maintain full employment. Those are their only two jobs. And the instrument with which they can affect these two things is a very blunt instrument called the interest rate that we all pay, the Fed funds rate, right? So a blunt instrument to try to tackle these two issues. And it's an effective instrument. Right? It certainly is effective because it has big impact on how companies decide to deploy capital, on how companies decide to make future investments, on how you and I might want to buy a house because mortgage rates are affected tangentially by the Fed funds rate. And so the Fed really is the one with the power to have a big influence on the economy and on our markets.
And we have a new Fed chair coming in.
We
and
do.
Everybody's wondering what's going to happen there, and I don't know that there's a consensus, is
Yeah,
there?
yeah, I'm wondering too. I mean, with a new Fed, obviously, a new Fed chairperson, obviously we don't have an understanding of the history, right, of what this person might want to do. Earlier this year, I think we had a pretty good sense for what the Fed as an instrument would be doing later on this year. We were expecting a couple of small, modest interest rate cuts, but then lots has happened since the beginning of the year. And so we think that those two might be off the table now. And I'm even starting to hear chatter about the Fed maybe raising interest rates in order to tamp down inflation, which has unfortunately reared its ugly head again. And so it is hard to say for the next 7 months or so until the end of 2026 what the Fed might do.
Yeah.
It really depends on what the economy gives us.
For the audience watching this, it's our beloved advisors all across the country. For those people working with retirees and pre-retirees, does election uncertainty change the way how they should really think about managing risk, managing income planning, and things like that for these retiree clients?
Yeah. So I think you kind of hit on it already with the question that you asked, right? The most important thing is to have a plan, right? And to understand that the decisions that we're making today and the instruments that we are using to activate those decisions are ones that we're all comfortable with and ones that we are able to stick to, right? I think that's really the most important part. A lot of what's happening in the political realm, what we hear on the radio, on the internet, we read in print, a lot of that is noise. Right? A lot of that is noise, and we are certainly sensitive to the fact that a lot of investors who don't live and breathe this financial stuff like you and I do every day, may be caught up in it a little bit, and that trepidation is absolutely natural. But I think what we do in the industry, the most important service we can provide to our clients is to help them understand what's happening and to keep a steady hand on the till. To make sure that we don't make any rash decisions based on whatever headline is coming down our way. That steady eddy, that plan, sticking to the plan, is really the most important part of it all.
Well, and the news cycle now, I mean, financial advisors find themselves to be therapists most of the time.
Indeed.
We're trying to keep everybody calm, during uncertain times. But they find themselves in a situation where there's an echo chamber in social media. Not a lot of people are doing any research anymore. I mean, I'm going to just say it. There's not a lot of critical thinking going on here. I think back, before there may have been times when you did research and you built your opinions around that, but now you're hearing everybody else's, and that's really the news. How does somebody turn down the news cycle when you've got a client who is in that world, in that echo chamber?
Yeah. So we try to appeal to obviously all different facets of what feeds into a client's thinking about this, right? And certainly, and this is you know this, we do have to keep our focus on what the end goal is here, right? Keeping our eye on the prize, because we try to explain to our clients that the decisions that we make today may feel pretty good in the moment, but we have ample history to tell us that if we start making some rash decisions that go against our own best interests, that down the line, we may be suffering here, right? And so the way that I always approach it with clients is just keep in mind, what are our goals, right? What are we trying to do? And make sure that we take the steps to get us there, as opposed to reacting to everything we see. I don't deny anybody's feelings, right? And people feel what they feel, and they have every right to feel those things. And we talk through it, and we talk about the things that we can control and what we might want to do in response to some of the things we hear. And then there are other things that we kind of share with folks. This maybe is not something that we want to affect how we want to make decisions.
Sure. Well, we've learned a lot of lessons from past cycles.
Absolutely.
Has any of that sunk in? I mean, investors still commonly make mistakes based on what they appear or they think may be happening.
Yeah. So I reach back to history, right?
Yeah.
And I like history.
Yeah, I can tell.
And when I don't even have to go back really far, to think about all those times when something big has happened that, again, in the moment feel very significant, and we feel like this has never happened before, and that we really need to have a strong reaction to what we're seeing is happening in the world in order to safeguard what it is we're trying to protect, right? I mean, those are all very valid ways of thinking about reacting to big things. But let's just think about the last 2 years, okay? What have we had? We've had tariffs announced on the world,
yeah.
right? And then we had backing off tariffs. We had a couple of banks go down, right? That didn't feel comfortable. And then we have this conflict in the Middle East, right? This is just within the last 2 years. And time and again, we've seen investors, as expressing their sentiments through market performance, telling us they see what's happening, they can process what is happening, and realize that as time marches on, as long as they stick to their plan, instead of jumping in and out, that they're going to be far better off, right? And even with recent examples of what we're living through.
Yeah, and you talk about, I guess finally, when the tariffs hit, I think last April, the market dumped 3,000 points opening bell. A lot of people jumped out, and then that thing rebounded very, very quickly, and they missed out on a lot of that.
Absolutely. No, it's a great example. No, I'll give you another example. March 28 of this year, when we hit the low for 2026, right? We were down about 10% in the markets year to date at that point, and now we've rebounded about 15 to 16% from there. So, you miss out on a couple of these really big days, you can really do damage to your financial security.
He is Howard Shen, Vice President and Invesco. Howard, this is such a great conversation. I want to have you back again.
Sure.
Is that okay with you? Do you have the
so.
time? You seem pretty darn busy.
I will make the time.
Thank you so much. This is the Quantum Industry Insight podcast. It's a regular conversation we have. Sometimes it's a little more irregular when things go sideways. We need to talk more. But thanks for watching. We'll see you next time.